It is my pleasure to introduce you to our speakers, Edward Dondlinger and Chuck Thornton of R.C. Thornton Accounting Group, a Phoenix, Arizona accounting firm specializing in complex accounting and tax issues. Our firm's mission is to help clients achieve financial success. That means saving on taxes too. Today we will be discussing the One Big Beautiful Bill. Welcome, Edward and Chuck. I will turn the presentation over to you.
Chuck, as we've heard during the campaign and lately on the news, the One Big Beautiful Bill. Let's call it the Triple B from now on. Now, this isn't final, but there is some progress being made there. Would you explain where we are in the process of the law being passed, caveats, and general considerations?
Sure. Thanks, Ed. The bill has to go through the House. It has to go through the Senate. Then sometimes it goes through a reconciliation process. Sometimes it goes back and forth. But eventually, when both the House and the Senate agree, then what will happen is the president signs it and that becomes a bill. Where we are in that process right now, we're at the House side of this. So the House probably about 10 days ago passed their version of it. It's still to be argued in the Senate. And if you watch the news, there's already some discussions about certain things people aren't happy with. My suspicion is there'll be changes in the Senate. Then it'll go back to the Joint Committee on Taxation to go back and forth, and then presumably it would go to Trump. So anyway, that's the process, how it works. And we seem like we're at the end of the process because so much was campaigned on this, but we're actually still in the early stages of the process for this passing or not passing.
So if this bill isn't even passed yet, why bother worrying about it now? After all, there will probably be some changes anyways.
Well, Ed, I think you're right. I think there will be changes in it. I think the reason why we do typically wait until the laws are passed before we actually do these presentations, but this is a little different. There's a lot of tax law that was enacted back in 2017-18 when Trump was president the first time, with phase outs that we're going to eliminate everything starting January 1st of 2026. So if the law doesn't pass, you kind of know that there's going to be a change anyhow back to the retroactive. An example is the estate tax exemption is a particular one. I think the other is I do think there's a high probability that good sections of this thing will pass. Some of them are very pro taxpayers, some are a little bit different. There's some things that if you wait until it's passed, you might not have enough time to start reacting on it. So you might want to start getting your ducks in orders on the areas that are relevant to you, that if it passes, you like to be prepared. If it doesn't, you might be disappointed. So planning a little sooner, jumping the gun a little faster is probably a merits consideration.
So then, Chuck, let's go on and discuss some of the categories of the changes.
Okay, now there's always a challenge in these changes. You could say, well, let's talk about individuals, let's talk about businesses, let's talk about enactment dates and things like that. I'm going to go with the process. We'll talk about the individuals, but keep in mind if you're an owner in a pass-through entity, such as a sub-S or a partnership, by default, this stuff's going to come to your individual return anyhow. So a lot of the stuff is in the individual. I would say let's go ahead and start with that.
Okay, so I know we can't go over everything, but can you give us some highlights, maybe some general categories, and then we can select a few if we have time to talk about?
Okay. I'm just going to do a rapid fire here, and if it catches someone's attention, you can certainly give us a call on this. And then, as I suggested, we'll probably just select a few that we think would be appropriate. So here we go. Rapid fire. Individual rates were reduced under the Trump's prior law. They were scheduled to go back up to the law before then. This would keep those in play as they are right now. Standard deduction for everyone increases $1,000 for single, $2,000 for married filing joint. Child care credit goes up from $2,000 with a $500 bonus to $2,500. Pass-through entity deduction, which was a big thing when Trump passed that, is called 199A deduction, which was 20% of the income coming from the entities, which was a deduction on the individual return, going up to 23%. That's pretty nice. Okay. The estate tax exemption, which right now is probably around $15 million per person, would stay on track. as opposed to it basically going down to the prior amounts. Mortgage interest, which would have gone up to $1 million of debt on a house, well, it was reduced to 750, so that would stay too if that's the case. Here's something. When's the last time anyone's ever deducted interest on their car? Been quite some time. And so now certain cars will have interest deductions, miscellaneous deductions that were done away with under the prior Trump change will still stay away. No tax on overtime. We're going to talk about that one. No tax on tips. We're going to talk about that one. And Social Security, well, it's a bummer, but we're going to talk about what happened with that. There is a $150 itemized deduction for people who don't itemize. It's a adjusted gross income. Here's something new: Trump accounts. The federal government will put $1,000 into a Trump account for your children for $5,000 per year. You get put in for children under 8. That's a different one. And then the salt and local deductions, the limitations on our property taxes and state income taxes is going to increase. You might recall it was $10,000 under the Trump law change.
Okay, thanks, Chuck. Would you pick a few and give us a little more deep detail or information or tips?
Sure. We mentioned the interest on the car. I said, hey, how long has it been since anyone's been able to deduct interest on their cars? This is obviously designed to do domestic type manufacturing. So they use the word cars assembled in the US. That's an interesting phrase. You think manufactured, what about the parts? So the car has to be assembled in the US, and you can deduct the interest on your car up to $10,000, but phased out with your AGI over 100,000. If you're single, it would be 200,000. If you're married, it's phased out by 20%. You can take it whether there is a standard deduction or not. So I'm going to point out that a lot of times phase outs usually tie into $250,000, $400,000. That seems to have been the theme going back to, I guess, to Barack Obama time. Now these adjusted gross income numbers are changing over the place. There's no rhyme or reason. I think they dial these numbers to figure out how much revenue they're going to lose by doing this. And so anyway, and so the phase out on this, keep in mind, $100,000, $200,000 if you're married, but then it starts phasing out with the 20%. The miscellaneous deductions for people who have a home office, as an example. Home office has kind of gone out the window some time ago for most people who are employees. Publications, dues, and things like that that we used to deduct about 4 years ago. Well, Trump's prior tax law did away with the miscellaneous deductions. Why? Because they were going to supposedly reduce the rates and get rid of all this little nitpicky stuff they called on that. I would expect that will probably be repealed continuously. It's a revenue getter, so why would they basically change it? So anyway, what's our tip here? Something that we probably ought to be talking about is if you have your own company, uh, creating an accountable reimbursement plan for things like your home office and automobiles, if they're in your name, as an example. For your employees that are working for a company that don't have control over the policies, if it's a small company, we've had some clients go and prevail in their discussions with their employer to change their compensation arrangement to provide the automobile comes out of a reimbursable plan and so on. Uh, I could take an hour talking about this. We don't have that kind of time. So if you've had miscellaneous deductions in the past, this might be something that we want to talk about with an accountable reimbursement plan. So there's two right there.
We heard a lot about the no tax on overtime, tips, Social Security. Would you go into a little more detail on that, Chuck?
Sure. I have to tell you, I was kind of a skeptic when I heard all this campaigning going on, especially when I heard the part about no tax on Social Securities because, I collect Social Security. So of course that was a lot of interest to me and a lot of other people do too. But let's take a look. These deductions are nicer, but they are more geared towards not certainly our typical business owners, but people who are more the average type owners. No tax on overtime. When this campaign took place, we thought, well, if you worked overtime, you're not going to pay taxes on anything. What it is it's tax-free to the extent that you have a premium. So if you're making 20 bucks an hour, but overtime's time and a half, then the premium is $10 for $30, but the taxable portion is not taxed on $10. And so I think all of us listening to the literature months ago thought all of it would be tax-free. It's just the premium portion. And this phases out, and here's another phase out. $160,000. I don't know where they got that number from, but it's not your 250, 400,000. So that phases out. So if we had someone who's working overtime, married to someone else who has decent wages, it may be that this is academic. It may be that there's not a deduction for it. No tax on tips. And again, that is for income that you earn as a tip. We always think restaurants, but how about the people who check your baggage and stuff at the hospital or the airline? How about the ones that do that at the hotels and so on? And so everyone now can start being creative about let's all get paid on tips. Well, the IRS is going to come out with an occupational study that's going to say here are the people who customarily get paid tips. They don't talk anything about FICA taxes on any of this stuff at all. And again, the adjusted gross income is $160,000. And after that, it's not a phase out, just disappears after $160,000. So Social Security, sad to say for me, I never thought this one was going to go through the way they promised for a lot of different reasons. Budget reconciliation needs 60% votes. They're never going to get that. And also to the taxation of Social Security benefits. That revenue goes back to the Social Security coffers to help support Social Security. So if they truly didn't tax Social Security, then a big source of revenue was going to disappear. So what they did is they said, we'll create a standard deduction for people over 40 or 65 years old. Standard deduction, $4,000 per person who's over 65. So if you're married, found joint return, both of you over 65, it would be $8,000. So now, do you have to collect Social Security to be able to get this deduction? Like, for instance, let's say that you wait until you're 70 to start collecting on Social Security, but you're age 66. Do you still get this? And the answer is yes, you do. So although people lump this in, they say it is the substitute for Social Security. It really doesn't tie into Social Security at all. It's just simply an additional standard deduction. Interestingly enough, we see an erosion of standard deductions versus itemized. This deduction, standard deduction, you can take the $4,000 whether you itemize or whether you take the standard deduction. So we talked earlier, $1,000, $2,000 increase in standard deduction. That's only if you take the standard deduction. We talked about the interest on the automobile. You can take that whether you itemize or not. We're going to talk about charitable contributions. You can take that whether you itemize or not. Same thing with this deduction for Social Security. Basically, it's not a deduction for Social Security, by the way. You can take that whether you itemize or not. So that's kind of nice. And then the last one we'll talk about probably a little bit more. Back when Trump passed this law, he put a limit of $10,000 on income taxes and state taxes. And this really caused a big uproar when it came to states like Colorado and New York, because they have higher income tax rates. And people worked around the clock trying to figure out a way to get around this. And they call it SALT limitations to work around. And a lot of our clients are doing this. Arizona is one of the states that allows you to do it. That cap, which was $10,000, is now being increased to $40,000, but phases out for people with adjusted gross income of $500,000, 30% of your income over $500,000. So this is just as a major change.
Well, that means for clients, Chuck, that have pass-through entities, they can get that and also a new greater limitations on their taxes. Is that correct?
Well, you remember, Ed, when you and I were talking about this originally, I said, wow, this is too good to be true. For our clients who have the pass-through entities, we'll continue doing what we were doing. And basically then what we'll have is a larger amount we can bring in those property taxes and things like that. There is a catch on this whole thing. And it is unclear how it's going to work. This law is difficult to read. It's piecemeal. But the theme of it is they're not going to let you get around the $40,000 limitation by doing the pass-through, which interestingly enough, the IRS blessed this back when the limit was 10,000. So they're taking it back. I believe the way I'm reading this is that you'll show those pass-through taxes on a K1. And then what you do is that gets added, probably added back into your income. And then you treat it as a payment and you basically subject everything to the $40,000 limitation. That's my guess. I'm probably pretty close to how this is going to work. So this may not be good for all clients. It may be we'd be happy with the 10,000 and do the pass-through entities, but for people that don't really have businesses, this might actually be good.
Chuck, how about before we run out of time here, some sampling of some business changes? Can you hit a couple of those, please?
Yeah, let's do a few. And remember, some of these things we talked about through the pass-through deduction, the SALT, the 199A, that's kind of business and also individual. So we hit a lot of ones there too. Depreciation is a big one. Our bonus depreciation on assets that we acquire, it was scheduled to go to 40% this year, 40% of assets acquired, 20% next year, and that was scheduled. That was going to be it. And now we're back to 100% of it being deductible, starting, I don't know where this date came from, January 19th of 2025 through 2029. And so if you're curious what was so important about January 19th, I had no idea. That's how a lot of these laws get written. Someone has a particular thing and they want to make sure their constituent gets into it. And it goes through 2029 because this is but some of this is a budget reconciliation bill in itself also. Implications for this, well, if you're going to buy equipment and you were holding off trying to straddle this, maybe now's the time to do it. For people who do cost segs with real estate, we have quite a few people do that. It brings the cost seg for new buildings um, back in play from nice deductions to fantastic deductions in this case. So I would consider this when new buildings are being constructed, or if you bought a building as an example. Opportunity zones is another one. Opportunity zones is the theme of, open up in this area where we have low income individuals by you providing jobs, opening up that area. You're helping that local economy, the states and the federal government come out with what's called opportunity zones, and they give you credits or different things. I'm not going to get into this. We had some clients that do it though. The opportunity zone was scheduled to self-destruct, terminate in 2028, but starting January 1st of 2027, it's going to terminate. You might say, oh, why are they doing that? Because there is a new opportunity zone called Opportunity Zone 2, of which you have to stand by, but apparently it's going to be the new improved one, of which who knows what that's going to mean at this point, but I presume it would be better. So if you have an opportunity zone, you might actually be happier in 2027 than you were with the 2026. Expensing for small business, business assets under 179 is there. There's some phase outs, but we won't get into that. And just a few more. The employee retention credit, which you might recall, we were doing seminars left and right when this stuff was coming out. It was a real great gift to people. And as you've heard, a lot of people abused it too. And so in the original law, they said the statute of limitations on this was for 5 years. Normally, assessing a tax for an underpayment was 3. So it gave the IRS another 2 years to go after people on this. And they decided that they need to give them another year. So now they're going to make the statute of limitations 6 years, double what it would have been originally. And here's the sad thing: if they assess it and you pay back the ERC, let's say in year 5, you've already paid the taxes on it anyhow, which is kind of sad because there's no provision for it to go back. And there's really probably no action to take on this at this point, other than just realize that you have exposure for another year further than what you thought. And then I guess there's a lot of other provision in here, but I think, Ed, as you pointed out, we're running low on time, so I'll stop at that point.
Thanks, Chuck. And unfortunately, you're correct. The time is out. So let me get this over to Kit to close out. Thank you all for listening.
Thank you.
Thanks, thanks
Thanks.
everyone for watching, and thanks Edward and Chuck for this informative presentation. If you would like to contact us, please call 602-678-7067 or email info@rcthornton.com. We invite you to visit our website, www.rcthornton.com, to watch more videos from our speaker series page. Contact info will be in the description below. Please let us know if you'd like to collaborate on a video regarding your topic. We would love to work with you. Thanks again and have a great day.